and this is Alex, and in today's video we'll be analyzing over 3,000 different stocks and how they correlate with each other, and we'll create look at different correlation clusters that we can create in Neo4j graphical database. So let's first start with an initial data set that I have here in my Postgres server that I have running locally. So I have this table with stocks data daily, and I've already went ahead and added certain metrics to the open, high, low, close, and volume, and added things like the percent change from close to open, the close percent change since last close, the volume percent change, things like the low percent change since open, the overnight change from the close price of yesterday to the open of today. I have the symbol, the exchange, extra fields like the year and the quarter, which are not going to be that interesting for us. The central index key of the company that's associated to that symbol. So I went ahead and put this data into equities daily table. So let's take a look at a top 100 rows in this table. Let's get for a visual sense. So here I have the date, the central index key, the symbol, the exchange. I have the open price for the day, the percent change from the previous day to the open price, the high, low, and these are fairly simple metrics to calculate. You can calculate them in PostgreSQL using lag and lead window functions, where you just get the previous close price. You can then take the percentage difference with the current price. So that should be fairly simple to do once you get a table of stocks data that you can purchase, or you can download it for free. There's many stock data vendors out there that you can download the data for free and spin up your own instance of Postgres and dump the data in. Okay, so let's get into some of the more interesting things. So the first things that I've noticed is that not every single symbol is traded every single day on the exchange. So it's not the case that all symbols are always traded. So for example, one of the first things that I did here, and let's take a look at this subquery specifically. So what I have here is I'm looking at only the data from 2007 to 2022, and if I just look at this query here, I need to do a group by, and let's not do let's not do the halving. So we have a symbol, the number of days that I have it in the data set traded for. I'm doing a group by, and I will see that certain symbols are traded more frequently than others. Okay, so this is spanning 15 years of data. Okay, and so if I divide this number by 15, I'll see what is the average number of days that has been traded for. And so this could be because some symbols simply haven't been listed for 15 years. Some may have been delisted, but there are certain symbols where there's no transactions, there's no trades that happen for the day, so there's literally no record of open, high, low, close. There's certain types of symbols like that do exist in the market. So by adding this halving clause, what I'm essentially saying is I'm interested in a symbol that's traded at least an average of 230 times 230 days in a year times 15 years. So this is sort of an average number. I'm simply looking for symbols that exhibit a certain volume of trade so that they can be more easily correlated against each other. And you can see here I'm returning about 3,075 symbols that have been on the stock exchange for at least 15 years. I could have picked a different time span. It didn't have to be starting 2007. You can just do for the previous year. You'll get a different number. But just for the purposes of this example, what I'm essentially doing is writing a query where I'm selecting from equities daily and I'm doing an inner join on this subquery, only looking on these years of data, and I'm saying only give me the symbols. I'm joining on symbol that have been traded at least on average 230 days for the 15 years. So I'll go ahead and run my query. I'm just waiting for it to complete. It shouldn't take too long. You have a fairly fast Postgres installation. I have M2 storage that I'm running on my local server. So it processed 12 million rows with that inner join. About 30 seconds. Let's go ahead and create a unique index by date by symbol. So this will add integrity to our data set to make sure that we don't have any duplicates in our data set. We want to make sure everything that we're doing has the right data structures enforcing data integrity. And this will make sure that we don't get tripped up in our analysis going forward, especially when we have inner joins, group by clauses flying around. We can easily misjoin something and create duplicate records. Okay, so our data is unique by day by symbol, so that is good. This is a quick distribution query, so this will show us, for example, I'm looking at symbol by count date, and then I'm simply taking days traded by symbol. So I'm looking at to see how many symbols if I make a distribution. Okay, and it looks like if I just remove this limit 1, let's give it a limit 100 because that just gave me the top frequency. So it looks like 2,089 symbols out of my data set have been traded for 377 days in the last 15 years, and then 149 missed a day of trading, and then 46 missed 2 days of trading, 28 missed 3 days of trading, and as we can see, this sort of tail off. Now if I didn't have this cap here, 230 multiplied by 15, which I can easily tell you what this number is, then we would have a longer distribution tail, case 450. So this distribution cannot go below 3,450. But it is good to see that the majority of our stocks symbols, they're not all stocks. There's ETFs in here as well. So it's ETFs and stocks have essentially traded every single day for the last 15 years of the open days for the New York Stock Exchange and the NASDAQ, and I guess ETFs also get traded on the ARCA exchange and various exchanges, so they haven't skipped a trading day, or at least there's a few stocks that skipped some, and then these numbers kind of tail off into different numbers that become less meaningful, because if you skip 20 days versus 21 days, it's less meaningful. So because we do have some symbols that weren't traded every single day, if we want to create a good, robust correlation matrix, what we want to do is impute missing dates for the symbols that were not traded every day, right? And so the first thing that we want to do, let's create a list of every single date. And so what we have here, let's create a table of all trade days. We're just doing a select distinct date. Okay, so we have 3,843 days that of total open market trading days for those 15 years. Now let's take another table of every single symbol that we have in our data set. So these are all the different equity symbols that we have in this particular data set. We have 3,075. Of course, that's not the entire stock exchange, right? That's just the ones that we have in our data set, the ones that have met our criteria for the trading days for the last 15 years. Okay, so what we want to do now is take these 3,075 symbols and create a Cartesian product of all the dates. So this Cartesian product creates a scaffolding for us where we have a permutation by date by symbol for all of the dates and all of the symbols. And so this, when we join to here, this will allow us to impute missing values. Okay, so what we have here is 11 million, right, 817,000 rows of permutations. So this guarantees that we don't have any missing dates or symbols. Let's go ahead and create a unique index on our table, permutation table. We called it complete date symbols. And of course, it should be unique if we did everything right, if we made sure that we had a distinct clause on our date and our symbol, and then we simply did a cross join between every date and every symbol. We know that we should have a unique combination between the two. And so all we want to do now is take our complete date symbols table and do a left join to our previous equities daily table on the date and the join. And so by using your scaffolding table, when we do a left join, remember the symbols that didn't trade on a particular day, they will return null. So what we want to do is do a coalesce for the percent change and say 0. So that there's certain symbols that had a 0% change in price for that day because they didn't trade at all for that day. And so we want to impute a 0% change. And looking at a correlation by percent changes is what we'll be doing going forward, because that's the most intuitive way. Stock prices by themselves don't compare, because we're not looking at market caps. We're simply going to be looking at the change in percent in price between one stock and the other and how much they correlate. Here I have an example of the Wiz symbol, and returns 0 rows for some reason. Okay, well let's take a look at our data set. For some reason we don't have this symbol in here. I thought we did. Okay, there we have Apple. Apple's probably one of those symbols that was always traded. Let's take a look at something where we know our volume in dollars is 0. Let's take a look at one of those symbols. Let's highlight this. Okay. Okay, so we have different. Let's take a distinct set of symbols where they have, at least at some point, had 0 volume. Okay, so that means there's some values that are being imputed. I don't know, let's pick IDX here. Okay, let's rewrite this query a little bit. Select all from okay. Oh wow, looks like there's a lot of zeros here. I guess maybe it wasn't listed then. And then here looks like it may have missed certain trading days. I'm not sure what this looks like here. We imputed a value, so we can confirm, for example, 2009, 07, 03, that this value did not actually exist in our previous data set. Right, so let's go back to our original query up here. And let's take a look. And here we do not have anything for IDX for that date. So the row did not exist, but we imputed it with 0% change. Okay, so now I have this, right, so the volume, so yeah, if there's 0 volume here, we imputed it with, yeah, so for missing records, we impute them with 0 volume and 0% change. And so this is volume dollars, but we're not going to be looking at volume in our correlation. We're just going to be looking at percent changes for the stock. We're going to be seeing if one stock changed, you know, went up by 3%, what's essentially the correlation that, you know, every other stock went up by 3% as well, and find ones that are correlated. So we have this nice data set here that's complete. So I'll go ahead and export it to a flat file here, and I'll go ahead and run this. And then we'll create a correlation matrix of this data set using Jupyter Notebook that I also have installed locally. Okay, there we go. So we copied our 11 million rows. Okay, I will go ahead and log in to my server, alex8 data.directanalytics.ai. Okay, so where did I put it? I put it into my Postgres subfolder. So if I simply look in here, I should see my data set. Okay, so there's my complete date symbols, pc.csv, and what I want to do is go ahead and copy it over, copy it to my Jupyter working directory so I can use it in my Jupyter Notebook. So let's go back to our home scripts Jupyter Notebook, and we can simply copy it over from our Postgres home directory to our Jupyter home directory. So I can go ahead and change directories to Jupyter. Let's take a look at what we have. And there it is. That's my data set. Now I do want to make sure that my Jupyter lab is running, and I have a multiplexer session already started with Jupyter. And I'll go ahead and show here that I did in fact start the Jupyter Notebook, and it's running on my local host on port 8888, and running it without a browser, and that's my home directory. Okay, so if I open up my browser, I'll be able to log into my Jupyter Notebook, right? So here we are, and I have the equities correlation Python notebook open. Okay, and so this is the file name, complete date symbols PC. I have it right here. Now there's quite a lot of data in it, so I don't really want to open it up on my browser. I mean, you can, but I'll go ahead and load it into pandas and run this snippet of code, and then we'll just look and print a sample of the data set that we have. Okay, so yeah, it looks like we have our 11,817 rows by 4 columns. And we have date, symbol, percent change, and we have the volume dollars, and we're not too interested in volume dollars, right? So what we're interested in is just date, symbol, and percent change. So we'll create a new pandas data frame called percent changes, and then what we want to do is pivot it so that so we have the symbols by column. So I'll go ahead and run this, and we'll put the symbol values into columns and the dates by rows. And so this will create a matrix for us where we have symbols in the columns and dates as the rows, with percentage changes as the values in our matrix. Okay, so that's what we have. And we have 3,843 rows by 3,075 columns. So that's our symbols, and this is our distinct number of dates. And if you remember, these will match what we ran in Postgres when we did a select distinct on dates, for example, or select distinct on dates will be exactly that number. So what we simply did, there it is, 3,843. What we did is we simply pivoted that data. And this is much easier to do in a pandas data frame than inside PostgreSQL. There is a pivot module that you can do inside PostgreSQL, and I have used it before. But this is just simply way easier to do in Python. Okay, so I tried different correlation methods. That I tried one with scikit-learn, min-co-of-det, and this actually is not a correlation, it's a covariance. Creates a covariance matrix. There is another NumPy covariance matrix, but I realized the simplest thing for our analysis is to create a simple correlation matrix, and it runs very fast, and it's built in right into pandas. Okay, so this x variable, that's just our percentage changes pivot data set. I called it x. I suppose it did not have to do that, but that's just the way my brain thinks, I suppose. I decided to label it as x and ran the correlation function. So it runs fairly fast on a matrix that's essentially 11 million, has 11 million values. So we'll just wait a little bit. We know that the kernel is busy. Don't remember exactly now how long it took me to run this originally, but I think it was under 2 minutes for what I remember. Okay, well, while that's running, feature names. So this is literally a list of our symbols, and so here's the output, I guess. While our correlation matrix is running, oh, there it is. 1 minute and 13 seconds. I'll go ahead and show what this value is here. Yeah, just a list of our symbols. Okay, scroll. Okay, so now we have, I guess I called it df, but it's really correlation. So what I'm doing is, when you first get the correlation matrix, it doesn't have the proper symbol. So if I take a look at core df, let's go ahead and let's just print it so that you know what it looks like as the output. Okay, so you see here, it has this second layer of percentage changes, so it's technically multi-dimensional. And I guess this is the way it creates the output. But here we have symbol by symbol and the correlation between each symbol. And so that's the number that we get. We have a list of all our symbols and how they're correlated with each other. Okay, so what I'm doing here is I'm simply explicitly telling what its feature names are. And so when I print it here, it's the same thing, but it doesn't have that extra dimension on the side of it. So this makes it easier to output. And we can validate this, but let's just go ahead and now unpivot it using the melt function. And so what this will do is this again will create for us symbol 1 by symbol 2 rows, right? So with a correlation in the column values, right? So we're taking that matrix and we're essentially melting it to be for every single symbol multiplied by every single symbol, and this creates 9 million for 155,000 row table for us. Okay, so that's what the melt function does. Simply unpivots the data set and produces the matrix. I can now output this data to CSV. We'll call it symbols core. We'll give the index label symbol 1, right? So our index here is symbol 1, and we have symbol 2, and that's their correlation. I'll put that to CSV. Now I have to make sure that, yeah, okay, so this is sampling the CSV. We're looking at using the head function. Okay, and it's output to our scripts Jupyter directory. All I have to do is move it to our Postgres directory, and then we can import it back into PostgreSQL. And so here I'm creating this table here, symbols correlation, symbol 1, symbol 2 correlation, and I'm copying it. Oh, sorry, I don't have to move it to Postgres. I can copy it directly from my Alex home directory into symbols correlation table. And so we can go ahead and truncate it and import that data set. Shouldn't take too long. Now, one thing I did want to do is verify some of our correlation data with the Postgres correlation function, and that it does indeed match. So I wrote this query. For example, I picked the top two easiest symbols, symbol A and symbol AA, and see what their correlation is. Now I'm just simply saying select date percentage change from these two subqueries and joining on date, and then looking at the correlation between the two symbols. I also added standard deviations because difference between the covariance and the correlation is literally the factor of their two standard deviations multiplied. And so here I can generate the covariance and the correlation. So let's take a look if okay, so we inserted the data correct. So let's do some data validation. I'll go ahead and run this query. So I can see here I have the correlation is 0.48 between A and AA. If I go back to my Jupyter Notebook, I see here A and AA 0.48. Okay, and when I look at it here in my correlation matrix, here's A and AA 0.48. Here's A and AA again, 0.48. So, of course, this matrix is going to have 1 down the diagonals because the correlation between the symbol and itself is always 1. And then, of course, you're going to have the same values on the diagonals of the matrix. Okay, so let's go back here. We went ahead and imported our data. Let's go ahead and create a primary key. So symbol 1 by symbol 2 is going to have a primary key on it. So we have to we're just again enforcing we don't have any duplicates in our data, which if we've done everything properly, there should not be any. Okay, and then what I'm doing here is I'm deleting all those 1 correlations. I'm deleting where symbol 1 equals symbol 2, right? So I'm not interested in how much Apple correlates with Apple, because that's not interesting. It's always going to be 1, so I'm looking to delete symbol 1 and symbol 2 correlations. Okay, so it's taking some time to create the primary key. I think I already have a primary key on this table when I created it. So it's actually giving me an error. It says multiple primary keys are not allowed. But what this means is because I already had a primary key on this table and I inserted this data after truncating it, there was no errors. So that means the data is in fact unique. And when I run this delete command, it deleted those 3075 rows where the symbols match themselves. I created a separate schema, called it graph, because we're going to show this data in Neo4j, make a graph out of it. And I'm just simply moving it from my transform schema to my graph schema. Again, adding that same primary key. I have so I have a dimension table with all the security information and the symbols and the company. I won't go over it in detail. I'm essentially interested in certain properties of the symbol. For example, the type of equity, the company name, if it has a central index key, things like industry classification code, industry category, yeah. And so what I'm doing now is after I've created I have to make sure that I have a primary key on that table. So it's by symbol, security and company information. And I'm adding foreign keys from my symbols correlation to my security and company information. So I'm saying there's 2 foreign keys, 1 for symbol 1, 1 for symbol 2. And that's how Neo4j is going to know that there's a relationship. Here we can quickly take a peek at our security and company information table. And here I just have symbol, what the security name is. Is it a stock or is it an ETF? Most of my ETFs, I don't have a central index key, but for some of the stocks I do. So I know what the actual company is. And I have an industry category for some of them. So we'll see that show up in Neo4j. Okay, so let's go ahead and log in remotely into my server, and I used the Neo4j ETL tool and went ahead and imported this data, and it took quite a while to import this data. I don't have date stamps on here, but import the initial data set of like the 30,000 is not difficult, but creating all those relationships, those 9 million relationships between the symbols, that took about like 4 days. So this has been running for a while, so I saved you the trouble. I got one error at the end where it failed to create constraint, where it says assert symbol is unique, and that's just because the ETL tool for Neo4j, it's still using some of the old Cypher language where it says replace on with for and assert with require, but that shouldn't really change the nature of my data set. And so so I created this EQ core database inside Neo4j, and when I do look at some of the logs, I'll show you that one of the reasons it was so slow is because when I looked at the query log, and I can scroll up, it was creating every single stock relationship line by line, and it was definitely taking a while. So there's definitely certain things that Neo4j can optimize in the future, especially with large data sets. But I'll let that be as is. That's otherwise a really neat tool to use. So let's just go ahead and start working with it and playing around. So I'll go ahead and exit out of here, and I'll open up my version of Neo4j here and just connect. I'm just connected remotely to my server running on it. So I can go ahead and open my database up. And so here I am in Neo4j, and just to confirm that I'm connected to the EQ core database, not the default Neo4j database. What I can do now is write a Cypher query. So I can write match. CS will be an alias. Oh, why am I seeing this? Okay, security and company information dimension. And let's return count star. Okay, so I'm seeing 31,000. That's because that's the total number. Not all of them will have a relationship, and that's because, right, so I'm not only looking at the 3,000 that I made a relationship chart for. There'll be many other symbols that I have in my database that are going to be not have a relationship to each other. So they're just going to be standalone nodes. If we want to make sure that we imported our correlation data correctly, let's write another query where we have match as security and company information has relationship symbols correlation to, let's do S2 return count star. Okay, so what I'm saying is give me the total number of relationships that I have between symbols. And so here's the number, 9,452,000. And so when I go back to Postgres and I look at graph symbols correlation, right, I'll do a select count star from here. And let's run that. 9,452,550. Okay, and so that is the number of relationships. So I can, so I got the relationship data imported correctly, and that's the data that I'm interested in. So let's go ahead and run Neo4j Bloom. That's sort of the graph database visualization tool. Okay, so I've pre-created certain ciphers. So SPY top correlated symbols. I only did a limit by 10, top 10 descending. I could change it to 100, for example. So what I'm doing is match security company information where symbol is SPY, has a relationship to a different symbol, returning the SPY, the correlation, and the other symbol, sorting by correlation descending, limit 100, right? So top 100 correlated. So let's go ahead and run this one, SPY, top correlated symbols. Okay, and here's my top 100. And I have different colors. So when I went ahead and went here for industry category, I applied colors by unique values. So purple are stocks and yellow are ETFs. So there's a lot of ETFs that have a very high correlation with SPY, and I guess that's because a lot of the ETFs either encompass a subset of the SPY. So here's the S&P 500 ETF trust. And because it's so special in this analysis, what I'll do is I'll actually give it an industry category of its own. Well, let's call it SP 500 ETF. And that will just give it a different color. Okay. Oh. Yeah, industry category is SP 500 ETF. So let's see if the rule-based. Okay, so yellow I guess also means unknown or ETF, which is kind of odd the way it's doing it. So I have missing values. So perhaps I should fill in those null values. Otherwise, anything that's not a stock is also yellow, or if it's an ETF, it's yellow. Okay, well, or we could maybe change some of the default colors. Oh, perfect. So maybe we can do gray for unknown values. SPY will remain yellow. Okay, so now I wrote this other very interesting query, highly correlated symbols. So symbol 1 has a relationship where the correlation coefficient is greater than 0.8 with another symbol. Return them. Okay, so it does take a little bit of time to run that query, but let's go ahead and say highly correlated symbols. And here's where we'll see the different clusters in the stock market really show up. And of course, this is only for stocks that have, have 15 years of history together. We could alter those parameters and let's say the last 5 years, or we can impute more values for symbols that weren't listed, but that will just bring the correlation down if we're comparing to a symbol that wasn't listed yet, and their percentage change would be 0. So it might not be fair to do that. We could play around in pandas with how it might maybe do the correlation with missing values, and read up on that documentation how we could do that better. Okay, so here we have some of the data clusters coming through. Okay. So they're still kind of moving around. Still wait for it to settle down so I can move my screen easier. Okay. So we're starting to see some interesting cluster relationships. Okay, there's our S&P 500 here in the middle. Let's actually move it over. And so it really belongs here in the middle, because we can really see this huge bloated cluster in the middle that to me says that this is sort of the market in general. There is the general market movements where everything is sort of correlated with the S&P 500. Lots of ETFs and different stocks there that are quite correlated with S&P 500. But then we have these interesting cluster offshoots. So what we have here in blue, let's maybe zoom in a little bit. I know this cluster is still moving away from me. So we have this interesting offshoot cluster, and so this is the real estate and construction cluster right here. These are all the real estate stocks, and they're all very highly correlated with each other, and then they have this sort of relationship to the market in general. Let's look at these pink clusters. These are all the finance. These are where we have all the banks and hedge funds and different finance sector. And so they have their own little offshoot cluster here to the market. Let's take a look at this green cluster right here. Energy. So energy and transportation. Suncor Energy. Okay, so this is, we're going to have all our oil and gas companies, and here's some of the ETFs that track them. Here in the middle, they're all quite highly correlated with each other. Let's see, what is this blue? Light blue. Technology company. Oil States International. I guess they're called the technology company, but we see they're very highly correlated with the oil and gas sector, right? So yeah, so that's quite interesting. We have a different light green cluster here, another energy and transportation cluster, and I'll have to look in more detail, but maybe this is some of the more new, innovative, sustainable energy. Yeah, I'm not sure, but I'll have to look into it. So we have this kind of interesting offshoot cluster from the market. Let's see what this, some of this red, manufacturing. There's some manufacturing stocks over here in this corner. And then we have some of these clusters here flying around, completely separate, at least not related more than 0.8 in their correlation coefficient. So I'm really interested to see what these, okay, Vanguard Total Bond Market ETF. Okay, so this is probably related, they're all highly correlated with bonds. So this is all a bunch of bond ETFs. Something that I'd like to do, okay, there's 7-10-year Treasury bond ETF, iShares. Okay, so if I had labels for all these data points, it'd be easier to see, but these are all essentially ETFs that are following the bond market, and so they're all highly correlated in their own little cluster there. So if you invest in one, it's maybe very similar like investing in the other. There's Liberty Media, Liberty Global C. That sounds like some class C shares of Liberty Media, so it's like just one company that has different class of shares that are highly correlated. We have John Hancock Preferred Income Fund. Okay, so preferred income, right? So this is some kind of funds that have clusters of preferred shares. Not sure what specific companies are invested in, but they're all highly correlated. Okay, here we have United States Gasoline Fund. So these are finance. So this is these are finance companies, but they're actually invested in commodities, probably related to oils, energy. So there's a different type of finance here. 12-month oil fund, right? So the different kind of finance sector than traditional banking. Gold. Okay, here's gold. The gold field. So here's a little cluster of gold correlated stocks, symbols, ETFs. Let's figure out what this one is here. And again, if I had better descriptions for these symbols, which I could get, TV Aztec, I'm not sure what that is. It might be easier for me to understand. Of course, I could look them up. So QID, if I go to stocks and I look it up, QID, ultra short QQQ. Okay, so there's some sort of market inverse shares that are highly correlated. Okay. Here's some interest. Looks like, oh yes, that's their gold fund. It looks like some stars, constellation. So yeah, actually they all kind of look like constellations, which is kind of funny. So this is just one interesting way to visualize data using Neo4j, and we're looking at how these different stocks and ETFs correlate. Now, of course, this does not include all of them, because again, we only included ones that have at least 0.8 correlation coefficient, and we just I just picked that as an arbitrary, cutoff time. But it's already created some very interesting results. Some of the things I like to do in the future is clean up this data set a little bit more, add labels to all the nodes and data points, and if I wanted to create a portfolio of different stocks or symbols or ETFs, I might want to know how well is my cluster, is my portfolio correlated with itself and with the rest of the market, and whether other clusters is it going to be correlated within, if my goal is to have a well diversified portfolio. And then if I'm just interested in exploring the different data sets. So this has been my demo using Neo4j and I've used Neo4j Bloom to analyze stocks. And thank you so much for watching. If you're interested in this content, you're looking to analyze stocks yourself, you're interested in financial analytics, you can reach out to me. Please subscribe to my YouTube channel. I enjoyed creating this video and exploring this data set, and I'll definitely be using what I'm learning in my self-learning discoveries as well with this data in my own investment strategies. Again, I'm not here to recommend any particular portfolios or stocks. My goal is to help and empower people to make their own decision using data-driven analytics, and learn some cool data tricks on the way. Okay, thank you so much for watching, and you have a nice day. Bye-bye.